2 companies. That's all it takes to make the entire S&P 500 look healthier than it actually is. Goldman Sachs just flagged Amazon and Alphabet for distorting the index's earnings growth, and most investors don't realize what it means yet. Here's what's really going on and what you should be thinking about right now. Goldman Sachs is sounding the alarm. Strip out Amazon and Alphabet, and the S&P 500's earnings growth story falls apart. Right now, the broader index is posting headline earnings growth, numbers that look solid on the surface. But Goldman says those numbers are being propped up by just 2 mega-cap tech giants, Amazon, Alphabet, 2 companies out of 500, and they're doing the heavy lifting for the entire index. Pull those 2 names out, and the rest of the index, all 498 other companies, is showing significantly weaker earnings growth. The foundation is thinner than the headline numbers suggest. And here's the kicker. The S&P 500 is already trading at elevated valuations. Investors are paying a premium for growth that may not be as broad-based as they think. Layer in an active Iran war geopolitical backdrop right now, and the risk calculus shifts dramatically. Markets are pricing in resilience. Goldman is questioning whether that resilience is real. If you're a passive index investor, holding SPY, VOO, or any broad market ETF, you are directly exposed to this concentration risk. You may not realize how much of your portfolio's performance hinges on just 2 stocks. But here's what nobody is saying about this yet. This isn't just an earnings story. It's a passive investing story. Millions of everyday investors poured money into index funds believing they were buying diversification. What Goldman is telling us is that the S&P 500's growth narrative is narrower than advertised. And when passive money chases an index that's this top-heavy, concentration risk compounds silently. You don't feel it until you do. First, pull up your holdings right now. Calculate your actual exposure to Amazon and Alphabet across every fund and position you own. Concentration risk hides in plain sight inside index funds. Second, consider the equal weight argument. An equal weight S&P 500 ETF distributes exposure across all 500 companies. Right now, that distinction matters more than it has in years. Third, watch the earnings revision cycle closely. If Amazon or Alphabet disappoint, the headline S&P 500 earnings growth number doesn't just dip, it craters. Know what you own before that moment arrives. Goldman just pulled back the curtain on one of the biggest myths in passive investing right now. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor.